Chapter 2 illustrated basic relationships in the accounting equation and showed how to prepare financial statements. Chapter 3 introduces tools accountants use to analyze business transactions, as well as the chart of accounts. In the first objective of the chapter, we will learn how to set up T accounts for all assets, liabilities, and owner's equity accounts. The accounting equation is one tool for analyzing the effects of business transactions. However, businesses do not record transactions in equation form. Instead, businesses establish separate records called accounts for assets, liabilities, and owner's equity. Accounts are written records of the assets, liabilities, and owner's equity of a business. Use of accounts helps owners and staff analyze, classify, record, summarize, and report financial information. Accounts are recognized by their classification as assets, liabilities, or owner's equity. Asset accounts show the property a business owns. Liability accounts show the debts of the business. Owner's equity accounts show the owner's financial interest in the business. Objective 1 is to set up T accounts for assets, liabilities, and owner's equity accounts. Accountants use T accounts to analyze transactions. A T account consists of a vertical line and a horizontal line that resembles the letter T. T accounts are helpful when analyzing transactions. Above are examples of T accounts for assets, liabilities, and owner's equity. Using T accounts simplifies record keeping by grouping all transactions of a particular type together. Note that assets are on the left side of the accounting equation. To increase any asset account, you have to record the dollar amount on the left side of the T account. Since liabilities and owner's capital are on the right side of the accounting equation, to increase those accounts, you would record the dollar amount on the right side of the T account. Objective 2 is to analyze business transactions and enter them in the accounts. Take a look at the 3 steps shown and keep them in mind as we go through the transactions. Now that we know the rules regarding increasing and decreasing asset, liability, and the owner's capital account, let's record some transactions. Let's consider the initial investment of an owner. For this transaction, let's assume that Carolyn Wells withdrew $100,000 from personal savings and deposited it in the new business checking account for Wells Consulting Services. Remember that assets are on the left side of the accounting equation, so to increase them, we would record the entry on the left. Because owner's equity is on the right side of the accounting equation, to increase them we would record the entry on the right side of the T account. Analysis. A. The asset account, cash, is increased by $100,000. A. The owner's equity account, Carolyn Wells Capital, is increased by $100,000. Since investments cause cash to go up, we would record the $100,000 cash increase on the left side of the cash T account. Since the investment causes the owner's capital account to go up, we would record the $100,000 investment on the right side of the capital account. Remember that debits must always equal credits. Always. Our next transaction is when the business purchased equipment for cash. Wells Consulting Services issued a $5,000 check to purchase a computer and other equipment. Analysis. B. The asset account equipment is increased by $5,000. B. The asset account cash is decreased by $5,000. Since equipment is going up, we would record the $5,000 equipment increase on the left side of the equipment T account. Since the check causes the cash account to go down, we would record the $5,000 outlay of cash on the right side of the cash account. The next transaction we need to record is the purchase of equipment for credit. This time the purchase is on account. Remember, when a business buys something on account, it means that they are agreeing to pay later. Buying something on account causes debts of the firm to go up. Liabilities are amounts a business owes to its creditors. They appear on the right side of the accounting equation. Assets equals liabilities plus owner's equity. Equipment is an asset, and so we show the increase on the left-hand side of the T account with a debit. The increase to accounts payable, a liability account, is shown with an entry on the right hand of the T account with a credit. As always, debits must equal credits. Our next transaction for the purchase of office supplies can also be recorded using T accounts. Since supplies is going up and it is an asset, we will increase this account on the left. Cash is the other account affected. It is also an asset, so we would decrease it by an entry on the right side of the T account. Recall that the firm purchased equipment earlier on account. It is now paying part of that liability by issuing a check to the vendor, Office Plus. Remember that assets are on the left side of the accounting equation, so to increase them, we would record the entry on the left. However, since this transaction involves a decrease in an asset account, we need to record the entry on the right side of the asset account. Because liabilities are on the right side of the accounting equation, to increase them, we would record the entry on the right side of the T account. However, in this transaction, since we want to decrease the liability account, we need to record the dollar amount on the left side of the T account. Since accounts payable is going down, we will decrease it by entering a $2,500 entry on the left side of the T account. Since the cash account is going down by the same amount, we will enter the $2,500 amount in the right side of the cash T account. When the business pays for 2 or more months of rent in advance, they are exchanging one asset, cash, for another asset, prepaid rent. Remember that assets are on the left side of the accounting equation, so to increase them we would record the entry on the left. Since we also want to decrease a different asset account, we need to record the entry on the right side of that asset account. Since the prepaid rent account is going up, we will increase it by entering a $8,000 entry on the left side of the T account. Since the cash account is going down by the same amount, we will enter the $8,000 amount in the right side of the cash T account. Objective 3 shows us how to determine the balance of a T account. An account balance is the difference between the amounts recorded on the two sides of an account. It can be computed at any time. When we foot a column, this means to add down and write the total at the bottom of the column. Subtract the smaller of the two totals from the larger of the two totals. The result is the account balance.
And transform them into sweet and festive cake toppers. So let's get started. A standard decoration in any
When we determine the balance of an account, we add both sides of the T account and then subtract the smaller side from the larger side. The difference is the balance of the account. Calculating the account balances simply means adding up or footing the total of both sides of the T account. Use footings for columns that have more than one entry. Then subtract the smaller total from the larger total. The result is the account balance. You will see a demonstration of this in the next slide. This table shows the possible balance alternatives that could exist in an account. To determine the balance of the cash account, we would add, foot, the total of the right side, which equals $17,000. Since this side is smaller than the left side, we would subtract the $17,000 from the larger $100,000 left side. The difference is a left side balance of $83,000 in the cash account.
I'm a 14th prestige on Black Ops right now, so don't mess with me.
Here is a visual presentation of the T accounts and their balances at the end of the month. Notice that the total of all the asset account balances equal the total of the liabilities and owner's equity. $103,500 equals $103,500. As you look at this slide, notice which side of the account the balance is on. All accounts have a normal balance. This is the side that receives the increase. You will notice that assets have a normal left side balance, or debit. Liabilities have a normal right side balance, or credit. And the owner's equity account, specifically capital, has a normal right side, or credit balance. It's important to recognize that all accounts have normal balances.
Anchor Homes, a company I work with often that buys and flips homes.
Section 2 of this chapter shows us how to record revenue, expense, and withdrawal transactions into T accounts. The fourth objective of the chapter explains how to set up T accounts for these additional accounts. Let's get started.
Without being able to go inside of it. They have about a 30-minute leeway, and it's very exciting because it keeps me on my
To
toes.
increase a revenue account, we would credit the account. If we would want to decrease the account, we would do the opposite, so we would debit the account. The next transaction will be to record revenue from services sold for cash. Take a moment to review the transaction. Let's consider the transaction where Wells earns $11,000 from various charge count clients. Since we have completed the work and earned the money, we increase or debit our accounts receivable for $11,000. We also increase our fees income account by recording a credit for $11,000.
White appliances, essentially everything clear to the back wall was open for a dining space, which just didn't.
Wells Consulting collected some of the money owed by its customers. Let's see how to record this transaction in our T accounts. Both of the accounts utilized are assets. One asset, cash, is going up, so it is shown with a debit. The other asset, accounts receivable, is going down, so it is shown with a credit. Here is the transaction, which has been entered into both of the affected accounts. Cash is debited by $6,000, and accounts receivable is credited by $6,000. As the business incurs expenses, it causes total owner's equity to go down. Remember, since owner's equity is on the right side of the accounting equation, to decrease total owner's equity, we need to record the entry on the left side of the expenses T account. Let's see how to record a business expense in the T accounts. Remember, as the business incurs expenses, it causes total owner's equity to go down. Since owner's equity is on the right side of the accounting equation, to decrease owner's equity, we would record the dollar amount on the left side, or debit side, of the expense T account. Remember that assets are on the left side of the accounting equation, so to decrease them, we would put the entry on the right, or credit side of the account. We know that cash is the asset account, which needs to be credited for the $8,000 check written. Salaries expense is the owner's equity expense account affected for the same amount, so we need to debit it for $8,000.
Sure, the current homeowner hasn't done a Band-Aid job because, wow, I can't even imagine closing.
Let's see how expenses are recorded. Remember, as the business incurs expenses, it causes total owner's equity to go down. Since we incurred the expense, we increase or debit our utilities expense account for $650. Cash is going down, so we credit cash for $650.
Inspector is what I like to call the I dotter and the T crosser.
The home inspector's sole responsibility is to provide you with...
Recall that drawings are not expenses of the business, but part of the owner's financial investment, which she is pulling out of the business for personal use. A drawing account is a special type of owner's equity account set up to record the owner's withdrawal of cash or other assets from the business. As the owner withdraws resources for personal use, it causes total owner's equity to go down. Remember, since owner's equity is on the right side of the accounting equation, to decrease total owner's equity, we need to record the entry on the left side of the drawing T account. The drawing account acts like an expense account. It is increased with a debit, and thus it decreases owner's equity.
So I thought, hey, why don't I go to the mall, round up a few kids, bring them back to my place, and teach them a few things.
Let's record this withdrawal. Remember, as the owner withdraws funds for personal use, it causes total owner's equity to go down. Since owner's equity is on the right side of the accounting equation, to decrease owner's equity, we would record $5,000 on the left side, or debit side of the drawing T account. Remember that assets are on the left side of the accounting equation, so to decrease them, we would record the entry on the opposite side, or credit side of the cash account. Carolyn Wells' drawing is debited for $5,000, and cash is credited for $5,000.
Let's face it, we've been washing our face the same way forever. This is your upgrade.
We have been mentioning debit, left, as we discuss T accounts. Have you noticed this? Debit just means left side of the T account. Credit means right side of the T account.
At the end of your day. Then change the mode, flip it over, and these waves give you an
We will be using the terms debit and credit from now on to describe how a transaction affects an account.
Clean your face is said to get out more dirt and oil and also to help you absorb any beauty products that
Here are the rules for all asset, liability, and owner's equity accounts. It is important that you study this slide and refer to it often when studying. These are fundamental rules for accounting students to learn. Our fifth objective is to prepare a trial balance using the balances in our T accounts. A trial balance is a report to test the accuracy of total debits and credits after transactions have been recorded. A trial balance just tells us whether total debits equal total credits. You can review the 6 steps shown. This is what a trial balance looks like. Notice that total debits equal total credits. Sometimes our trial balance does not balance. Review the common errors in a trial balance. If you discover that your trial balance has an error, you can try refooting it to check for math errors. You should ensure that the correct balances from the account were transferred over to the correct debit or credit balance. If you know what normal balances are, this will assist you in locating errors. You can look to see if a transposition error or slide error occurred. Sometimes just double-checking your work will disclose the error. Refer to the textbook section on finding trial balance errors for more guidance on this topic. Objective 6 shows us how to use the trial balance to create our financial statements. We use the information from our trial balance to prepare our financial statements.
Checking to make sure your frame is plumb. Screw in your cement board.
Once the income statement is finished, you can do the statement of owner's equity and use the ending balance of the Carolyn Wells capital account to complete the balance sheet. Our last objective is to develop a chart of accounts. This is simply a list of all of the accounts that you use to do the record keeping in your business. Account numbers give more meaning to the chart of accounts. See an example of a numbering system for a chart of accounts on the next page.
And for more money. Research shows that a properly staged home can do just that. But staging doesn't end.
Accounts that begin with a 1 are assets. Numbers that begin with a 2 are liabilities, etc. Notice that spaces between account numbers allow you to add new accounts or make other changes to your chart of accounts as time passes.
Now I understand you have children, so this is their little play area, but for the open house, that's just not going to cut it. So
Let's now introduce the concept of permanent and temporary accounts before we end this chapter. Permanent accounts continue to exist from one accounting period to the next. Assets, liabilities, and the owner's capital account are permanent accounts. Another name for permanent accounts is real accounts. Temporary accounts only have a balance for one accounting period. Their balance is not carried over to the next accounting period. Examples of temporary accounts are revenues, expenses, and drawing. Another name for temporary accounts is nominal accounts. We have covered many important rules in accounting. You may wish to review this chapter one more time before continuing on to the next one.